Welcome to the deep dive. Today, we are setting aside the headlines about price action and turning our attention to the foundation. We're performing a critical, almost surgical examination of the core Bitcoin protocol, moving well beyond the daily narratives to confront the deepest questions about its long-term survival.
And it's a necessary analysis.
It really is. We've collected a formidable stack of sources, the best academic papers, cutting-edge developer proposals, and detailed market analyses that collectively lay bare the fundamental structural vulnerabilities facing Bitcoin, specifically looking out over the next decade from 2025 to 2035.
It's so important to do this because for so long, the idea of Bitcoin has been synonymous with, immutability, this perfect digital fortress that needs no maintenance.
Right, sit and forget it.
Exactly. But our sources suggest this confidence is reaching a critical inflection point. We are seeing 4 clearly defined structural vulnerabilities that are not theoretical, but mathematical and converging.
And you've categorized them.
We have. We're looking at them as 4 vectors: economic security, cryptographic integrity, protocol governance, and finally, infrastructure centralization. And the timeline for confronting these is shrinking fast, with a lot of them converging right around the early 2030s.
So the thesis we're confronting today is monumental. Bitcoin has to execute a transition, a really difficult one.
It has to move from a security model, where miners are paid mostly by the block subsidy, the inflation, to a model where security is paid for almost entirely by transaction fees.
And it has to do this while facing down these looming existential threats like quantum computing and also a self-imposed obstacle, what developers call the ossification trap.
Governance paralysis,
Yeah.
It's the ultimate engineering challenge of decentralized consensus. I mean, can a decentralized, politically conservative protocol adapt fast enough to survive these inevitable tech threats?
And can it accelerate its economic density before the subsidy cliff just drops the network into a state where it's, well, affordably vulnerable?
That's the question. It's a trade-off between stability and adaptation.
And for you, the listener, understanding these deep structural dynamics is absolutely essential. If you want to stay truly informed about the future health of this asset, you have to look beyond the price ticker.
Right.
Understanding the engineering risks is just as valuable as tracking market sentiment. And speaking of which, a quick note, if you want to track total market temperature, we encourage you to search and download the iOS app Buffett Indicator from the Apple App Store. It gives you daily alerts and really helps you gauge the health of the overall market.
And of course, a quick but important disclaimer. All analysis here is based on publicly available sources and is for educational purposes only. This discussion does not constitute investment advice. Please conduct your own due diligence.
Let's dive in. Let's start with what is arguably the most immediate and mathematically accelerating threat, the economic security vector.
Yes.
This focuses on the subsidy cliff and this massive paradox in the fee market.
This is truly where the brilliant economics of the protocol meet the brute force of engineering reality. Bitcoin security is, well, it's purchased. It operates on a security budget.
And how is that budget defined?
It's the total revenue paid to the miners, which is simply the block subsidy plus all the transaction fees in that block.
And the problem is one half of that equation is programmed to disappear.
Exactly. The block subsidy, which has historically provided 95 to 99% of that budget, is halving every 4 years. It creates an exponential decay in the network's purchasing power for hash rate.
Since the 2024 halving, the subsidy dropped to 3.125 BTC per block. Our sources are emphatic that we are now officially in the phase where fee revenue must rapidly scale up.
It has to. It has to compensate for that massive, predictable drop. If it doesn't, the cost to attack the network just plummets relative to the market cap it's protecting.
So the critical metric here is that cost-to-attack ratio, right? Specifically for a 51% attack versus the total value being secured.
Precisely. And the academic analysis is pretty clear on this. Even with significant BTC price appreciation, the real dollar value of the security budget, when you adjust for inflation and the sheer scale of the financial system, it's actually declined.
To decline by how much?
By roughly 45% compared to where it was just before the 2020 halving. So price alone is not a sufficient defense against the subsidy's decay.
And this brings us to what our sources call the 1% problem. This just crystallizes how precarious the situation is.
It really does. When we look at the empirical data, we see that transaction fees currently account for, on average, only about 1 to 2% of the total block reward.
So 98 to 99% of the security budget is still coming from that decaying subsidy.
Yes. And that is fundamentally insufficient to fill the void that the halvings are creating. It's a rapidly widening security deficit.
I have to stop you there. That 1% figure is staggering. Was this something that was predicted, or did developers really expect the fee market to grow much faster by now?
It was definitely debated, but the current reality is worse than many optimists predicted. The assumption was that network usage would scale linearly with adoption, leading to consistently higher fee pressure.
But that's not what we've seen.
Not at all. We've seen these volatile fee spikes followed by long periods of low activity, and crucially, the realization that Layer 2 solutions are necessary, which inherently reduce the demand for high fees on the base layer.
So let's get into the alarming projections, especially looking out towards the 2030s. Walk us through this projected existential risk.
Okay, so the models assume that to maintain a credible defense against, say, a state-level adversary, which is the right threat model for a multi-trillion-dollar asset, the network needs to sustain a certain level of hash rate growth.
Which is the cost of security, and it has to be scaled against the cost of an attack.
Exactly. So let's focus on that critical period between 2032 and 2035. By then, the subsidy will be negligible. It's down to just 0.78 BTC per block.
Which is what, about 112 BTC mined per day?
Roughly, yeah. For context, in the 2024 epoch, miners received 450 BTC daily in subsidy. The projected data suggests that to maintain security parity, let's say keeping the cost of a 24-hour 51% attack above $500 million, the network would need to generate approximately 340 BTC daily purely in transaction fees.
Wait, say that again? 340 BTC daily in fees.
Yes.
Versus 112 BTC daily in subsidy. So fees would need to make up 3/4 of the entire block reward.
It's an astronomical requirement, an increase of orders of magnitude from where we are today.
And if that doesn't materialize?
If that fee revenue doesn't show up, the network enters what our sources unequivocally define as existential risk.
Why?
This isn't just about price volatility. It's about the fundamental ability of the protocol to even enforce its own rules.
So the threat is purely mathematical. By the early 2030s, the cost to launch a 51% attack could drop to a level that's just affordable for a state actor.
And it's made worse by how the mining market has evolved. The threat is no longer theoretical, because the barriers to entry are lower.
You're talking about hash rate rental markets.
I am. These industrial-scale operations, like a massive version of NiceHash, mean an adversary doesn't have to spend billions building data centers. They can just rent the necessary hash rate for the duration of the attack. It makes the whole operation temporary and much more viable.
The sources reference this chilling Goldfinger scenario, which really changes the threat model. It's not about making money anymore.
That's right. The Goldfinger scenario posits a state-level adversary, maybe one whose currency is threatened by Bitcoin attacking the network purely to destroy confidence.
So if Bitcoin is securing trillions, the goal isn't profit, it's just strategic disruption.
Exactly. If the cost to disrupt the network for 24 hours falls to, say, $50 million, that's a trivial line item in a nation-state's defense budget. They don't need to steal the funds. They just need to reorganize the chain, double-spend a large exchange withdrawal, and shatter the institutional trust that underpins the whole ecosystem.
And we've seen this happen on smaller scales, right? This isn't a unique vulnerability.
Not at all. Networks like Ethereum Classic, ETC, and Bitcoin Gold have suffered successful 51% attacks when their security budgets dipped. ETC had an attacker launch multiple double spends, disrupting exchanges, crashing the price. All because renting the required hash power was cheaper than the damage they could inflict.
So Bitcoin is subject to the same economics, just with a few more zeros on the end?
Precisely.
Okay, so the problem is solved if fees rise dramatically to cover that 340 BTC daily deficit. But this immediately leads to the fee market paradox.
Yes, a classic economic dilemma dictated entirely by the architecture. Bitcoin's capped block size, currently 4 million weight units, creates an inelastic supply of block space.
So when demand surges, the price of that space, the fee, has to spike.
It has to.
So what happens to the average user if fees jump to, say, $100 or even $500 per transaction?
They're priced out. Simple as that. If you're trying to settle a transaction for less than $1,000, paying a $100 fee is just untenable. Those users with lower value transactions just can't afford to be on the base layer anymore.
And where do they go?
They have three options. One, they go to layer 2s like the Lightning Network. 2, they move to sidechains. Or 3, and this is the worst outcome for Bitcoin's dominance, they move to competing altcoins that offer cheaper layer 1 settlement.
And that migration is what you call demand destruction.
It is. If enough of those users leave during a fee spike, the fee revenue collapses again, creating this extreme volatility that makes long-term investment in mining hardware unattractive, which then accelerates the security decay.
So the conclusion here is critical. The network can't survive by just increasing the number of transactions. That just bloats the chain.
Right. The only solution is increased economic density. A single transaction has to settle the aggregated value of millions of dollars of activity.
And that's what has driven this recent focus on programmability. The base layer has to transform into an institutional-grade settlement layer.
Exactly.
Which brings us directly to the technical remedy, covenants. Our sources define these as the key to economic salvation.
Covenants are the technical tool that enables this economic density. Simply put, a covenant is a rule that enforces conditions on how a specific coin can be spent in the future.
So it lets you apply programmable rules directly to the ledger.
Yes, going beyond the simple who owns the keys check. This is what allows scaling layers to aggregate thousands of user activities into one single, highly priced on-chain transaction.
And there are two big proposals on the table, OPC-TV and OPSET. Let's start with the minimalist one, OPC-TV.
OPC-TV, or Check Template Verify, is very targeted. It lets a user commit to a specific, predetermined future spending path. Think of a large custodian, like an exchange.
Making thousands of payments a day.
Exactly. Instead of 10,000 separate on-chain transactions, they can use CTV to pre-sign a tree of transactions and pay one large fee to consolidate all of them.
So the exchange pays one transaction of, say, $50,000 fee, which is what the miners need, and then amortizes that cost across 10,000 users, so the individual fee is still just $5.
Precisely. That one high-density transaction gets confirmed immediately, and the thousands of individual payouts can be unrolled later. It guarantees high-value block space demand for miners without bloating the chain.
Okay, now for OPCAT, which stands for concatenate. This is the more expressivist choice. It was actually in Satoshi's original design, right?
It was, but it was removed over some security concerns. Now it's being proposed for reinstatement, and it really is the keystone for the most advanced Layer 2s, especially ZK rollups.
And why is that? What makes it so powerful?
OPCAT is powerful because it allows a script to join data together. More critically, it allows for introspection, which is the ability for a script to inspect the details of the transaction that is spending it.
And that small change unlocks what?
It unlocks monumental possibilities. It allows for the verification of complex cryptographic proofs, specifically zero-knowledge proofs, directly on the Bitcoin base layer.
This is the ZK rollup unlock. Why is this seen as the definitive economic solution?
A ZK rollup can execute millions of transactions off-chain. The rollup operator then posts one single tiny cryptographic proof to the Bitcoin base layer, guaranteeing the integrity of all those off-chain transactions. With OPCAT, Bitcoin can actually verify that proof.
So if Bitcoin becomes the settlement layer for vibrant ZK rollups, where a single verification transaction might pay $5,000 because it represents $100 million in settled activity,
then the security budget problem is solved, instantly and sustainably. It creates a structural, non-stop demand for high-value block space.
The sources point to the ARC protocol as a key example of something that needs this.
It does. ARC uses virtual UTXOs for scalable anonymous payments, but without covenants like OPCAT, ARC transactions are interactive, meaning both parties have to cooperate to exit.
Which is less trustless.
Much less. With covenants, ARC can achieve a unilateral exit system. Users can pull their funds out without relying on the service provider. That's the trust you need to attract consistent high-value demand and thus high fees for miners.
So the conclusion of this economic vector is clear. The weak point is the declining subsidy. The remedy is high-density fees enabled by covenants. And the risk is that if governance fails to implement them, the network risks economic starvation by the 2030s.
All right, let's pivot from that gradual economic decay to a more binary existential risk, the cryptographic integrity vector, or the quantum threat horizon.
If the economic problem is a slow-motion car crash, the quantum problem is a sudden catastrophe. It's a cliff.
And it all comes down to the algorithm.
It does. Bitcoin relies on ECDSA elliptic curve digital signature algorithm. This algorithm is fundamentally vulnerable to something called Shor's algorithm.
Which is what a quantum computer would run.
Exactly. The moment a sufficiently powerful fault-tolerant quantum computer, a CRQC, is operational, it can derive a user's private key from their exposed public key in polynomial time. ECDSA signatures are just broken.
And the scary part is that a specific chunk of the Bitcoin supply is vulnerable right now. This is the P2PK time bomb. This is the most immediate threat. In the very early days, 2009 to 2010, the default address format was pay to public key or P2PK.
And the key factor there?
The public key is explicitly recorded on the blockchain, unhashed, for everyone to see.
So those keys are already exposed. They're just sitting there, archived by adversaries, waiting for the technology to catch up.
That's it. An attacker doesn't need the owner to do anything. They just scan the blockchain history, collect all those visible PDPK public keys, and feed them into the CRQC once it's ready. Our sources estimate that between 2 to 4 million BTC are held in these vulnerable outputs.
2 to 4 million. And that, crucially, includes the legendary stash mined by Satoshi Nakamoto.
It does. Up to 1 million coins. The implication is staggering.
Yeah.
The moment a viable CRQC exists, those coins are technically compromised. Even if an attacker doesn't sell them, just the act of moving Satoshi's coins would shatter trust and trigger an unprecedented market panic.
Okay, what about the rest of us using modern addresses? The ones starting with 1, 3, or BC1?
They're significantly safer, but not entirely immune, especially if you reuse addresses. Modern addresses hide the public key behind a hash, usually SHA-256.
And SHA-256 is considered quantum resistant, right?
Generally, yes. A CRQC can't reverse the hash to find the public key. So, addresses that have received funds but never spent them are currently safe. The key is hidden.
So the hash is a shield, but when does that shield drop?
The moment the user spends the coins. To authorize a transaction, you have to reveal the public key in the signature. If you then reuse that same address for new funds, that public key is now permanently visible on the blockchain for all time.
And this leads to this terrifying strategy: harvest now, decrypt later.
Precisely. Any sophisticated adversary today is recording every single public key revealed in every transaction.
Yeah.
They don't need the CRQC yet. They just store the data and wait. Once the tech exists, they can decrypt all those recorded keys at once.
And how much is vulnerable there?
The sources indicate another 2.5 million BTC held in reused P2PKH addresses are also immediately vulnerable to this strategy.
So given this timeline, what is the defense? The community has a plan, BIP 360.
BIP 360, or Pay to Quantum Resistant Hash, is the long-term goal. It introduces new quantum-resistant address types. But selecting the right post-quantum cryptography, or PQC, algorithm is proving to be a massive engineering and political trade-off.
This is where we get into signature size versus security.
Exactly. This is where the physics meets the economics again. For example, a lattice-based algorithm called Falcon 512 is favored by some because its signatures are relatively compact.
Manageable.
Yeah, around 666 bytes. That wouldn't drastically bloat the blockchain, but implementing it safely is really complex.
And on the other hand, you have the ultra-secure option, SynCS plus SE, which has a huge problem.
SynCS Plus is considered extremely secure. It's hash-based, but its signatures are massive, often between 8 and 30 kilobytes.
30 kilobytes, what does that actually do to the network?
Well, remember the block size limit. If we adopted SynCS Plus signatures at the high end, a single block might only hold maybe 130 transactions.
Compared to 3,000 or 4,000 today.
Right, a throughput reduction of over 90%.
Yep.
It would collapse the base layer's utility, forcing almost all activity onto layer 2s, making the base layer a hugely expensive, slow settlement platform.
Which brings us right back to the economic security problem.
It does. If PQC requires massive signatures, the fee density has to be astronomical to survive. It just reinforces the absolute necessity of high-density L2s, which, as we said, requires covenants.
And speaking of covenants, OPSAT shows up here again, this time as a quantum lifeboat.
This is arguably one of its most compelling features. If a quantum emergency happens before the community can agree on and implement BIP 360, OPSAT provides an immediate defense.
How?
It allows users to construct quantum-secure Lamport signatures today using existing primitives like SHA-256.
So even if the governance process stalls on the PQC standard, which seems likely, OPSAT gives users the ability to move their funds from a vulnerable ECDSA address to a quantum-secure script.
Exactly. They don't have to wait for a soft fork and a minor signaling campaign. It is the ultimate break glass in case of emergency feature. It proves OPCAT is not just an economic scaling tool. It's a critical security tool.
Finally, we have to touch on the most politically charged issue here, the burning debate around Satoshi's coins.
This is where principles clash with pragmatism. If those 2 to 4 million coins are compromised by a state actor, the network faces an immediate monumental crisis. That's 10% or more of the total circulating supply.
And the community has two choices if the owners are inactive.
Choice 1 is the freeze. The community implements a rule to prevent spending from PDPK addresses, unless the owner can prove they've moved to a PQC secure address. It's complex, difficult.
And choice 2 is
the burn. The community enforces a rule making those vulnerable coins permanently unspendable,
which fundamentally violates the core ethos of uncensorability and immutability. You're destroying funds based on a centralized decision.
You are. But the defense is that allowing 2 to 4 million BTC to be stolen by a hostile state actor could collapse the price, trigger a debt spiral, and shatter the market's trust, leading to systemic failure.
So it's a violation of principles to save the entire economic system?
It will be the most divisive political event in Bitcoin's history if it comes to that.
So we've established these two massive threats, economic decay and cryptographic failure. But both of them rely on a solution actually being implemented.
Right.
Which brings us to the third vector, the governance failure, what you call the ossification trap.
This vector is the failure mechanism for the first two. It is the inability of the protocol to adapt fast enough to survive. And the problem starts with a very influential faction that advocates for protocol ossification.
They want to freeze the base layer entirely, make the code untouchable.
Exactly. The argument is that maximum stability attracts maximum institutional capital. Pension funds, sovereign wealth funds, they fear execution risk from software updates. They want the rules fixed, like gold.
But the risk here is immense. Our sources warn of premature ossification.
Or calcification, as some devs call it. Locking in known existential vulnerabilities, like the subsidy decay and the quantum threat, is not a conservative strategy. It is, paradoxically, a guaranteed slow-motion failure mode. Refusing to upgrade guarantees failure by the 2030s.
And we see clear evidence of this paralysis, maybe most clearly with a great consensus cleanup, a soft fork designed to fix non-controversial bugs.
It's the perfect tragic example. This proposal was meant to implement objectively beneficial maintenance. We're talking about fixing the time warp attack, where miners can manipulate timestamps, and fixing various SPV denial of service vectors.
So not controversial features. These are essential security patches.
They are, and yet they have languished for years without activation.
Why? Why has fixing a simple bug been stalled?
Because of the deep lingering trauma from the 2015-2017 block size wars, that battle taught the community a painful lesson. Any attempt to change the rules can trigger a massive schism.
So it created what you call a vetocracy.
Yes, a political culture where any change, no matter how necessary, is viewed with extreme suspicion. A small vocal minority can effectively block necessary maintenance, creating a state of perpetual stalemate.
And that stalemate is now directly preventing the economic solutions we discussed, specifically with covenants.
This is the current frontline battle. You have two main factions. On one side, the minimalists, who favor OPC-TV. They argue for simplicity, minimal code changes, solving only the targeted problem.
They're afraid of introducing bugs.
They are. They fear that broader programmability like OPSAT introduces too much attack surface.
And on the other side, the expressivists who support OPSAT.
They believe CTV is too limited, and that Bitcoin needs the full utility to enable competitive L2 ecosystems, like ZK rollups, which will actually solve the security budget in the long run.
And the outcome of this split
is functionally disastrous. Neither proposal has achieved the rough consensus needed for activation, so the network is stuck. If this deadlock continues, Bitcoin risks missing the vital window to build the necessary L2 infrastructure before the subsidy decline becomes fatal.
Governance failure is literally preventing the solution to economic security.
That's it.
So if this vetocracy stays in power, how does the community break the deadlock? The sources point to a historical precedent, the user-activated soft fork, or UASF.
A UASF is the ultimate tool for reasserting user sovereignty. We saw it used successfully with SegWit activation in 2017.
So the node runners, the users, they just start enforcing the new rule.
Exactly. They start enforcing the upgrade regardless of what the miners are signaling. They essentially force the miners to follow the new rules or risk mining invalid blocks that everyone else will reject.
It's a political power play, a high-stakes bottom-up maneuver.
It is. It's the nuclear option, but it might become necessary if the community realizes they're running out of time. A UASF may be the only mechanism left to break the deadlock on a critical upgrade like OPSEC.
Let's shift gears to the final structural vulnerability, the infrastructure vector. This is about the physical centralization of mining and the financial centralization of supply.
Right. This vector highlights that even if the code is decentralized, the physical world can still introduce critical points of failure. And it starts with mining. While there are thousands of individual miners, the power to construct blocks is dangerously concentrated.
And the sources point to a duopoly forming right now, Foundry USA and Ant Pool.
Absolutely. As of now, 2024-2025, these two dominant pools consistently control over 54% of the global hash rate.
Which crosses the critical 51% threshold.
It does, meaning those two entities, if they colluded or were coerced, could technically launch a successful 51% attack.
And this creates a profound and immediate censorship risk, right? Foundry USA operates under U.S. jurisdiction.
That means Foundry must comply with U.S. Treasury regulations, especially OFAC sanctions. If the U.S. government sanctions a set of addresses, Foundry is legally required to censor those transactions to exclude them from the blocks they build.
And Apple, with its ties to China, faces similar pressure from a different angle.
Exactly. Potential pressure from the Chinese government to reorganize chain tips or exclude transactions related to capital controls. Because the pools construct the block templates, they become these centralized choke points capable of introducing permission censorship into a permissionless protocol.
So what's the technical countermeasure here? The upgrade to Stratum v2.
Stratum is the protocol for communication between miners and the pool. Stratum v1, the current standard, lets the pool dictate the content of the block. Stratum v2 is essential because it completely shifts that power dynamic.
How does it change the relationship?
Stratum v2 shifts block template construction power to the individual miner. Instead of the pool sending a fully constructed block, the individual miner can choose to build their own template, selecting which transactions to include.
So even if Foundry is forced by the government to censor a transaction,
the thousands of individual miners connecting to Foundry can override that instruction. They can choose to include the transaction, decentralizing the selection process back to the edge of the network.
it removes the pool headquarters as a single point of failure.
It does. Adoption is happening, but it requires a massive, coordinated effort to upgrade firmware across millions of machines. But for long-term censorship resistance, V2 is non-negotiable.
Okay, now let's look at the financial side of centralization, a newer vector, corporate supply capture, which our sources are calling the MicroStrategy risk.
This is the emergence of a single publicly traded company as a systemic risk. MicroStrategy, MSTR, has an extremely aggressive accumulation strategy. By late 2025, they're projected to hold over 640,000 BTC.
Which is about 3% of the total supply.
Yes, with stated targets to accumulate even more.
3% held by one company is unprecedented. Walk us through their flywheel mechanic.
It's a self-reinforcing, recursive financial strategy. MSTR issues convertible debt or equity to raise capital. They use that capital to buy BTC. As the BTC price rises, MSTR's stock value increases dramatically.
Often at a huge premium.
A massive premium. They then use that inflated stock valuation to raise more debt to buy more BTC. It's a recursive cycle.
But using highly leveraged debt introduces a huge systemic risk of liquidation.
It creates a reflexive relationship where MSTR's health is tied directly to the BTC price. Many of their debt instruments have covenants. If the Bitcoin price crashes hard, MSTR's ability to service its enormous debt is compromised.
And the catastrophe is the liquidation shock.
Exactly. If MSTR is forced to liquidate, maybe from a debt restructuring, or if they are removed from an index like the S&P 500, the sudden dumping of 3% of the total supply would cause a catastrophic, instantaneous liquidity shock to the entire ecosystem.
Far beyond a normal price correction.
Far beyond. And beyond that price shock, MSTR's size gives them significant governance soft power.
They can't change the code, but
their lobbying influence and control over the institutional narrative could push the industry toward corporate-friendly changes, like protocol-level AML compliance, that would fundamentally erode Bitcoin's censorship resistance.
So what's the defense against this? It seems to require changing how institutions hold assets.
The primary defense is standardizing vault custody, using mechanisms like BIP 345 or OP Vault-style covenants. Instead of relying on centralized exchanges or ETFs that become these massive honeypots.
For hackers or regulators.
Right. Institutions should be encouraged to use self-custody that's secured by on-chain covenants.
And what does a vault covenant actually do differently from a normal multisig?
A vault imposes mandatory, time-delayed spending conditions. So if the key is compromised and a hacker tries to withdraw funds, they don't move instantly. The vault sets a mandatory unvaulting delay, say, 72 hours.
And during that time,
the legitimate owner can be alerted and trigger a clawback transaction to a secure backup address. It reduces the systemic risk exponentially. A hacker can't instantly steal billions from a honeypot, which makes institutional self-custody viable and helps decentralize the supply concentration over time.
We have now covered these four converging vectors: economic decay, the quantum threat, governance paralysis, and infrastructure centralization. Let's try to synthesize these.
The single most important takeaway is the severe convergence timeline. By 2030, Bitcoin potentially faces a triple threat scenario.
Okay, lay that out.
The subsidy is negligible, and fees are still too low. That's economic failure. CRQCs are mature enough to threaten the old coins. That's cryptographic failure. And continued ossification governance failure prevents the activation of the very tools needed to solve the first two problems.
That scenario is the ultimate test. So, given this convergence, which single solution offers the most leverage against all these threats at once?
Based on the analysis, the activation of OPCAT stands out as the single highest leverage asymmetric defense move the network can make. It addresses core issues across 3 of the 4 vectors.
Okay, let's summarize why it's so critical.
First, economic security. OPCAT enables the complex contracts needed for ZK rollups and ARC. This is the only feasible way to get the structural, high fee density needed to solve the subsidy cliff.
Second, quantum mitigation. It provides that critical quantum lifeboat. It lets users construct quantum-secure Lamport signatures today without waiting on the slow, contentious process of finalizing a PQC standards.
And third, custody and centralization. OPCAT is expressive enough to enable robust custody features like OP Vault. This provides the framework needed for secure institutional self-custody, reducing the systemic risk from centralized holders like MicroStrategy and BlackRock.
It really is a multi-purpose tool, and I assume deploying Stratum v2 rapidly is non-negotiable for defense too.
Absolutely. Stratum v2 is the essential, urgent upgrade needed to decentralize block construction and protect the mining layer from regulatory capture. It has to become the industry standard.
So the final implication here is stark. Bitcoin's survival is not guaranteed by its original design.
Not at all.
It requires active engineering decisions and overcoming this deeply entrenched governance paralysis. The strategy for survival has to be hardening the protocol through upgrades, not ossification, which just locks in fragility.
Exactly. True immutability requires resilience, and resilience demands adaptation against known threats. The idea that freezing the code makes the asset safer is a dangerous misinterpretation of engineering reality.
This has been a tremendously deep and intense dive. We've covered the full scale of the challenges, from the mathematical necessity of fees to the looming quantum threat and the complexity of the coordination required to solve them.
The next decade will define everything. The question is whether Bitcoin can successfully transition from a cryptographic experiment secured by subsidy to a global settlement network secured by consensus and high-density transaction fees.
And the debate now is no longer about if Bitcoin needs to change,
but how fast it can overcome its own resistance to necessary change.
That is the ultimate question. And speaking of foundational questions, we spent time on the vulnerability of the original P2PK coins, including Satoshi's stash. This presents a truly fundamental dilemma. So what stands out to you, the listener? Should the community consensus enforce a burn on those potentially lost, vulnerable keys to save the network's total value? Or is that a fundamental, unacceptable violation of immutability and property rights? It's the most challenging philosophical hurdle the network may ever face.
It's a challenge that pits practicality against ideology, and one we all need to consider.
Thank you for joining us for this deep dive into the structural vulnerabilities of Bitcoin. We hope this analysis has provided you with the foundational knowledge you need for the critical developments to come. If you found these topics fascinating and want access to more advanced content, we welcome you to join the Deep Value Club membership.
And as mentioned, if you want to track total market temperature, search for and download the iOS app Buffett Indicator from the Apple App Store. It provides daily alerts and helps you gauge the health of the market.
Also, don't forget to subscribe to our channel, Deep Value Investing, on Apple and Spotify podcasts.
We'll catch you on the next deep dive.